Welcome back to the Williams Real Estate Channel. Today we are running through the macro market update for September 2025. So to kick it off, as a lens that we look through as a guide, we use the 18-year land cycle framework. We are on the blue marker. We are 12 months away from peak market come 2026. Peak land market, that is. And then also 18 months to 2 years away from peak stock markets come 27. But by 2028, we'll be entering the next land-driven downturn, GFC 2.0. They'll call it something, but we're due. We use this framework to work out which markets to buy into, when to stop buying, when to renovate, when to develop, when to even sell out of, to ultimately build a large sustainable property portfolio. As you would be well aware, the likes of Brisbane, Perth, Adelaide, Darwin, and their respective regions are well away at the races. In the midst of the FOMO, every man and his dog is charging in, but that is not necessarily the most wisest decision to be doing at this stage of the cycle, as we're due for a reset. We're due, and when the market does turn, the ripple effect will come back to Sydney and Melbourne, where the demand will then re-enter those markets, and Sydney, Melbourne will lead again in the recovery of the next cycle, just like what they did from around 2008 to 2017 in the current cycle. So that's the framework we use to help us understand where each market sits. And then from that, we peel back the layers and work out which suburb is set to run and where to allocate funds to buy property, to fix up, renovate, to develop, and even sell towards the back end. If you are looking to scale and consolidate, it's always good to reassess your portfolio and see where each property sits within each sub-market, as there is not one property market. There's not one market that follows this framework. This framework is used to work out where we sit in the market, being middle of 2006 in the prior cycle. So that's the framework. That's what we use. We'll run through these future slides now to give you further clarity, to show how I believe we are on this blue marker, and we'll discuss key points of data throughout today's video. So stay tuned. First up off is the Australian GDP growth rate rose 0.6% this quarter and by 1.8% in the past 12 months. So starting to pick up a little bit, coming from both public and private demand, that is. So as wages continue to rise, that additional capital is being deployed into the markets, which is pushing the current GDP growth. In real terms, still pretty low. In real terms, it is being held back by the land market. Prices are just so high, it is restricting growth at this stage of the cycle. The unemployment rate has been slowly trending up since its trough in 2022 and is slowly trending up and has ticked up to 4.3% to date. Unemployed people increased by 4,100 people to 652,300. Youth unemployment rate increased to 9.7%, and the overall unemployment rate increased to 4.3%. Still low in historical averages, however, is starting to trend up. And if you look back through 30, 40, 50 years of unemployment rate, and the trends, once the trend starts to rise, it never goes back down again. So it has started. At some point, something will give great panic into the markets, and then businesses will start laying off people like going out of fashion, and that's when we'll see a classic spike, just like what happened in the mid-cycle slowdown, the COVID recession, as well as the GFC and the dot-com bust and the 91 recession we had to have. So it is on the way. It's starting. I don't see it running until probably around late 2027 to 2028. That's when we'll see unemployment shoot through the roof. But we're tracking this closely, along with the Australian inflation rate is currently sitting at 2.7% in the trim mean as of June 25. However, if we now have access to monthly indicators, which is great, and we'll see that over the course of 2025, inflation was trending down until it troughed out into June, and then as of June, it has started to trend up again. So the monthly indicator for July was 2.8%, and the monthly indicator for August is 3%. So it's trending up, as well as the unemployment rate trending up. So this could be signs that we could be seeing another wave of inflation on the horizon. So the RBA met on Tuesday. They decided to hold the cash rate at 3.6%. Their key remarks out of their statement included private demand is picking up over public demand as incomes continue to rise. Credit is relatively available to both households and businesses. Unemployment has eased, so it picked up to 4.3%. Still remains tight compared to historical averages. The possible negative impact of US tariffs seems to have been avoided at this stage, so that's positive. The rate cuts are yet to be fully priced in. So the recent rate cuts and the impact to the economy is yet to be fully understood. So they're holding tight and keeping watch of the data as it evolves. The RBA remains diligent to the evolving data, and they noted that they are well placed, meaning the cash rate is well placed to either drop further or increase higher to react to the evolving data, being both the unemployment rate and inflation rate. The decision to keep it on hold was unanimous from all members of the board. The next meeting is scheduled for the 4th of November 25, and the markets are now saying that there's less and less support from the markets suggesting that there's further rate cuts due to the tick up in inflation that is being picked up in the monthly indicators. So we'll have to wait and see what happens, but the chances of further rate cuts, I believe, are limited and probably not going to happen. If they did drop rates, we would only be further moving away from where the US is in terms of their federal funds rate, plus that would be inflationary as well. If they drop rates, it'll kick off inflation. So with inflation trending up, it's like a boiling kettle. They're hoping and praying that it doesn't run away from them. Otherwise, don't be surprised if rates are started to be jacked up again come 26, 27, which will ultimately end the cycle and send us into the next land-driven downturn come 2028. So we are keeping a good eye on the US GDP rate. There's no further data as of Q2, but a strong quarter off the back of Q1, which dipped into negative. Wasn't publicized throughout the media, which I was quite surprised. I would have thought that would have been blasted everywhere, but slipped through the radar that the US dipped into negative GDP in Q1, but has since rebounded quite strongly in Q2. But it is a key indicator we track and keep an eye on, as 2 quarters of negative GDP growth is technically a recession. The US unemployment rate also rose to 4.3% as of the end of August. So it is also trending up from its low in 2022, still at historically low levels. However, as I said before, once the unemployment rate starts to trend up, it never goes down again until it completely runs to the sky. So the key indicator we are watching is the US and the US unemployment rate, because the US typically leads and Australia historically trails 6 to 12 months behind where the US is at. The United States inflation rate is also on the up. It troughed out in April this year at 2.3% and has since been on its way, rising to 2.9%. They have a target of 2%, so they don't have a range of 2 to 3%, so it is well above their target. So it's quite interesting to see that Jerome Powell, the Federal Reserve, dropped the cash rate or the federal funds rate in the US in September to 4.25%. And that was a reaction to the higher unemployment rate. Even though inflation is also trending up, I would have thought he would have held, but looks to be moving towards a stagflation scenario where inflation could run high as well as unemployment in the years ahead. Okay, stock markets continue to rally to all-time highs, including the Australian ASX 200, the Dow Jones in the US, and the FTSE 100 in the UK. Classic sign of where we are in the cycle. Even though this is not being supported by earnings growth, it's actually more so being stimulated by the recent rate cuts. Been driven by, in Australia, by the big four banks hitting record high share prices. So CBA, $167, has a PE ratio of 27, so overvalued. Fair value is a PE ratio of 10. Westpac, again, hitting all-time highs, PE ratio of 19. NAB, hitting all-time high of $44 with a PE ratio of 18. And ANZ, close to record high with a PE ratio of just under 15. So credit is relatively available. The banks are making money. They're lending it into the market. That's fueling the property markets. Ultimately, the property market is credit. The accessibility to credit will ultimately filter down to the benefit of land and property prices. And when record share prices and record profits are being earned through the banks, they'll be able to continue to lend more money. And with rates coming down, that's only going to feed on itself, and more money is going to be easily accessible and pumped into the markets to see us out through the final boom phase. Also, this is then feeding on the construction and property industry globally, which is setting off our mines. So our miners are also hitting record high levels. Classic point of the cycle. As you can see, look what happened from 2005, 6, 7, and 8, pre-GFC. These miners all took off. And again, here we are in the eve, the final phase of the current cycle. So again, highlights where we are as of late. And in the background, we continue to monitor DR Horton, as DR Horton lost 66% over 27 months from July 2005 to October 2007 before the overall stock markets topped out. So this is a leading indicator. D.R. Horton is a land and property developer. So over time, as land price continues to fall in the later stages of the cycle, they'll be pricing in reduced earnings. They'll impact their share price. And as you can see, from 2005 to 7, it continued to trend south. Meanwhile, the rest of the markets continues to boom. So this is a leading indicator to see, okay, well, if it continues to trend south, then we could be close to the market top. So it started to trend south as of its peak in September 24, and then has since rebounded. I believe this is a dead cat bounce and will continue to trend down as a similar thing happened from late 2005. Before then, in 2006, 7, it continued to trend south. So a key company and share price and key data point we are tracking for the future months ahead. And also, I thought I'd throw in this: internal tensions are on the rise in Australia, the UK, and the US. I mean, you've obviously been seeing the Palestine protest and the Australia anti-migration protests. Same thing is happening in the US and the UK. This is classic tensions rising at this stage of the cycle when there is pressure on infrastructure, pressure on house prices, and migration also then fueling that demand. Tensions arise. So when the community are feeling the pinch, both the cost of living, the cost of rents, the cost of housing, it's where we are in the cycle. This would be happening. This is classic indication of where we are in this later stage of the boom when such activities and such tensions arise is classic point of where we are in the current market. So another indicator to show where we are, as always, this is general information, general content, by no means financial or general advice. This is just my thoughts, processes of where we sit in the market and how I all see it all panning out in the years ahead. If you want help building a long-term sustainable portfolio, a solid all-weather residential foundation portfolio, navigating the markets ahead because it's turbulent times, you don't want to get caught on the wrong side of it when the market turns. If you want help building a portfolio, hit us up today. Happy to jump on a call, discuss your plans, and see if we could work together and get a few deals this spring and coming into Christmas. Christmas and New Year time, best time to buy. There's a leftover stock that comes through from spring. And if the sellers don't sell before Christmas, they get desperate, they discount through the Christmas and New Year period. That's the best time to buy. There's a drop off in buy activity as people are checked out for the year on holidays. They're not looking to make a big commitment. So if you are ready, looking to take advantage of the current market and get a good deal, hit us up today. It would be great to chat and work with you on your portfolio for the years ahead. Until next time, thanks for watching.